All right, hello again. This is Mike with the Netpicks Inner Circle. In this week's options trade of the week, we're going to take a look at Target, symbol TGT. Target had their quarterly earnings this past week, and leading up to that earnings number, they pumped up the volatility in the options. Once the uncertainty was gone, once the number came out, they sucked the volatility right back out. So now we're left with a potential opportunity here to sell some premium and benefit from a sideways consolidation. If we just take a look at a simple daily chart of Target, you'll see I have a number of moving averages on the chart. It's actually difficult to see price action because we're sitting right underneath a number of moving averages. Since the earnings came out, we have had a nice move to the downside right into an area of support. Now, when we put on an Iron Condor, what we're trying to do, instead of trying to predict a big market directional move in one way or the other, to the upside or to the downside, with an Iron Condor, I'm trying to box in the price. I'm trying to create what we call a profit window. So instead of needing Target to make a big move higher or lower, as long as it stays inside of a range, I can generate some income from the time decay adding up and from volatility decreasing even more so than it already has. Right, so based off of my outlook on this chart, I want to be more neutral here with Target. I'm not looking for a big directional move higher or lower. So let's jump on over to the trade page and let's piece this together. So we have been trading a lot of June monthly options here of late, and there's a couple of reasons for that. Number one, price action has certainly slowed down. Okay, we've seen a lot of choppy price action in the last few weeks. We've also seen volumes market-wide contract. The volumes have been near very low levels, and as a result, it's been more difficult to get filled on the weekly options. The weekly options, in most cases, have lower liquidity than the monthly options. So if you ever get into a situation where you're just finding it difficult to get filled on trades, one way to increase your probability there is to just trade the monthlies. They're much easier in most cases. So we're going to trade the June monthly options. They have 21 days left to expiration. For those of you that might not be familiar with an Iron Condor, I know the name sounds a little complex, but all it is selling an out-of-the-money call spread and an out-of-the-money put spread at the same time. So the trades that we've been talking about lately, the last few weeks, we've been selling just a lot of straight call and put spreads. Now we're going to try to do both sides at the same time and create that profit window that we just talked about. So the trade that I'm pulling up here out in June, I'm going to go ahead and right click on the 73.5 calls. I'm going to go to sell and I'm going to select Iron Condor. And that's going to pop up an order down at the bottom. Now I've adjusted the strike prices here slightly. The whole goal when I sell an Iron Condor is I want to collect around 50% of the width of the strikes. You can see the difference between the strike prices here is $1. Difference between 73.5 and 74.5 and 70 and 69. So there's a dollar wide difference there. I'd like to collect as close to 50% or 50 cents as possible. That would give me right around a risk one to make one type of scenario. So I started to play around with the strike prices a little bit. I started to move them around, and I came up with the 73.5, 74.5 call spread and the 70, 69 put spread. Right now it's trading right at 50 cents. So if I can get filled at 50 cents, that's ideal. That's the perfect price for us. And if I hit confirm and send here, let's take a look at the details of this trade. If I'm collecting 50 cents, that's the most I can make on the trade, regardless of what happens on Target. I cannot make more than $50 per spread. The beauty on this thing is we're only tying up $50 of capital. So it's a very low cost trade. For those of you that have a smaller account size, this should be appealing. And if you have a bigger account size, you can trade this with multiple spreads. I mean, it's not uncommon on some products for me to come in and place my order with 40, 50 Iron Condors. It just depends on the product that you're looking at, depends on your account size and your risk tolerance. So if we do it one time, we're risking one to make one. My break-even points would be at 74 and 69.5. The 74 break-even point is calculated by taking my 73.5 call that I'm selling. I'm adding on the 50 cents that we're collecting. That gives me my break-even point on the upside. On the downside, I'm taking my 70 put that I'm selling, and I'm subtracting 50 cents, and that gives me my break-even point at 69.5. At this point, if I put this trade on now and get filled at 50 cents, all I need Target to do is to stay inside of those two numbers. So if it moves slightly higher, I'm okay. If it moves slightly lower, I'm okay there too. If it moves straight sideways, if we just chop sideways here for a few weeks, I can work with that as well. I make money in all three types of market movement. The only scenarios where I would get hurt here is if I got a big move to the upside above 74 or a big move to the downside below 69.5. But remember, my outlook here is more neutral. I'm expecting slower price action on target. So I'm not anticipating those big directional moves. That's the whole thought process behind an Iron Condor. So I make money if it moves slightly higher, slightly lower, or sideways. I make money if time decay adds up, and I make money if volatility decreases. So I've got 5 different ways of making money on the trade. Now, the key with an Iron Condor, and it takes a little bit of a transition in your thinking, because so many people are programmed to look for those big directional moves where you can book the big profits. With an Iron Condor, it's going to be a very slow moving trade. The P&L on this thing is not going to be very active, at least initially. It's also not going to give you the home run profit potential. So if you go into it thinking, hey, I have the potential here for a 200% return, it's not possible. It's not going to happen. This is a way for me to stay active in the markets, generate a little bit of income when I am not anticipating the big movement. When I'm anticipating the choppiness to kick in, this is a way for me to stay active. These are trades that I put on a lot of times during the summer months when the markets get quiet, we don't get those big moves, we don't get the big volume. This is a way for me to scratch out a little bit of profit in that indecisive environment. Right? So again, we're looking for target. If it just stays right here, if it stays inside of our profit window, we're okay. It's not going to take a lot of attention to detail. We're not going to have to pay attention to this thing all day long. With the June options, with the June monthly options having 21 days left, I might come in and check it once a day. All I need to check is to see is the current price of the stock inside of our 2 break-even points. If it's inside of 69.5 and 74, I'm okay. I'm okay with that. I can make money from that. My initial target zone is 75% of whatever we collect here to put this trade on. So if I'm collecting 50 cents, if I can buy this thing back for around 12 or 13 cents, that would be acceptable for me. That would give me my target, my desired target range. Now, if I hold to expiration, I could book the entire profit and let the whole thing expire worthless, not pay the commission to close out of the trade. The reason I'm not interested in that, and we've talked about this in recent videos, in order for that to happen, I'd have to hold right up to expiration. Expiration week, the gamma risk increases drastically, meaning the prices of the options are going to react very quickly to changes in stock price. You could go from a really nice profit to an immediate loss within a day or two. I don't like that risk. So if I can close it out ahead of time, book my 75% profit, I will certainly do that. So that's what we're looking to target on the target trade. So pretty straightforward trade. Nothing overly complex here. All we're doing is selling the call spread and the put spread at the same time. Right? So if you have any questions on this trade, certainly let me know. Either post a comment here in the blog or send me an email directly to mike@netpicks.com and I can connect to help you out there. Before we wrap up the video, let's talk about some of our open trades that we've talked about over the past few weeks. Let's start out with Apple. So on Apple, what we did, this was 3 weeks ago now, we came in and we were looking at the June 8th weekly options and we sold a call spread. We sold the 192.5, 195 call spread, and we collected 84 cents to put that trade on. It's now trading for 57 cents. This trade, we sent out an alert to our members here earlier in the week where we closed out of this trade and booked the partial profit. We actually bought this thing back for 15 cents. Okay, so it gave me $69 of profit per spread. The beauty here is if I go over to the chart on Apple, I just love how this thing played out because it was a perfect example of why selling premium can be so powerful. Let me go ahead and remove all the info here. Look at this chart of Apple. We really haven't done anything other than move straight sideways. I mean, we're less than $1 away from all-time highs. So when we sold this call spread, we were expecting Apple to move lower. It has done so slightly. Hasn't made a huge move lower. Okay, but it just kind of drifted sideways. The beauty when selling a call spread is that's all we need. I don't need a big move lower. So earlier this week, as you can see, we started the week, we were down and the low was right around that 185.60 level. We closed out of the trade, bought it back for 15 cents. Again, really nice profit. I still like Apple. This could potentially be a name that we circle back to next week and initiate another trade because we really haven't seen a pullback yet. All we've done is consolidated sideways. So this is just a prime example why if you're looking, to be active on Apple up near the highs, buying a call or a put may not be the best thing to do. Selling premium allows you to collect that premium up front, benefit from the time decay that would be there in case we just chop sideways. So perfect example of why these trades can be very powerful. Our trade from 2 weeks ago was on gold, or GLD. Let me go ahead and shrink all this down so we can take a look. So on gold, we went and we were using the June monthlies. We decided to sell the 122, 121 put spread. When we put this trade on, we collected 35 cents or $35 per spread. It's now trading for 19 cents mid-price. Okay, so we're in a profitable position. We want this thing to get as cheap as possible. Well, it's starting to work in our favor. Ideally, collecting 35 cents, if I can buy this thing back for between 9 and 17 cents, that's my desired profit range. So we're actually getting close. All we need is one more push to the upside on gold. It doesn't have to be huge. I mean, it could be a push this afternoon or even into early next week. And we're going to be able to close out this position with a partial profit. So again, anywhere you can place your closing order here, you can buy it back anywhere from 9 to 17 cents, and that would be okay. That would give us our desired profit. So we're sitting okay on this thing. Nothing to do here at this point. We're trading for 19 cents mid-price, so we haven't hit our desired profit. With my outlook not changing on gold, I'm going to try to target that 9 cent number. I'm going to place my closing order at 9 cents. We're going to have to hold this thing into next week. We have a long weekend upcoming here with the Memorial Day holiday on Monday, so markets are closed. That will allow me to benefit from that additional time decay, that additional day of time decay that's there. So that could potentially help us. We could close this trade out here. Any type of a higher open on Tuesday next week, and there could be a chance that we could go ahead and close this thing out at that 9 cent number. That would give us a really nice profit. So far so good on gold, just nothing for us to do at the moment. And then finally, XLE. This is last week's trade. We were using the June 15th monthly options, and we sold the 79.80 call spread. So clearly, with oil getting beat up here today, this trade has worked out really, really well for us. So when we talked about this trade last week, we were able to get filled at 37 cents. This thing's now trading for 4 cents. You could close this thing out and book the full profit, essentially full profit. You got 4 more cents of profit potential. So you could close it out with that partial profit if you wanted to. I'd have no argument on that one. So how do I know when to close it out early? When do I hold it? If I hold it longer, the benefit there is that it could potentially expire worthless and I keep the entire profit and not have to pay the commission to close out of the trade. The problem there is I would have to hold another 21 days in order for that to happen. So is it worth me tying up the capital on this trade for an additional 4 cents or $4 of profit potential and the savings from the commission not being paid? That's the question that you have to ask yourself. In most cases, if I have a trade like this with 21 days left and I've already got essentially a full profit, in many cases, I'll just close out of the trade, free up the capital, move on to the next position. Especially if you're using a broker like Tastyworks, who does not, they don't charge a commission to close out of the trade. So now it just takes that guesswork out of the equation. I'll just close it out, book the profit, and move on. Now, if you take a look at this, the 79 call that we sold has a 94% chance of closing out of the money. The probabilities are working in our favor here. So if you wanted to hold it, if you don't mind tying up the capital in this trade, the numbers are certainly in your favor that this whole thing is going to expire at expiration, expire worthless, and you get to keep the entire profit. So, I don't have a problem either way. It's just for me not having to pay that closing commission with Tastyworks anymore. I'm just going to go ahead and close out of the trade, book my profit, move on to the next trade. So that's just another winner for us. We've just been on a tremendous stretch here with these trades of the week. We've had, I believe, I'm trying to go back and look at our records. I believe we've had 1 losing trade out of, I'm trying to go back, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 trades. So we're 12 wins and 1 loss on the trades of the week. So they just continue to perform really well for us. Hopefully, if you've been tracking along, you're starting to see the power in selling premium. It doesn't give you the home run profit potential that you would have with a long call, long put, but it gives you such a higher winning percentage. It's a great way to have more of a stress-free type of a position, and that's why I'm so attracted to these types of trades. All right, so we'll continue to track our open positions going into next week. We'll continue to track target now with the Iron Condor we talked about today. If you have any questions at all, feel free to send me an email, mike@netpicks.com, or just leave a question or comment here in the blog, and I'll get back with you right away. All right, so I'm going to go ahead and wrap this video up here. I'll be back next week. We'll reevaluate things at that point. Enjoy your weekend, everybody. We'll talk to you next week.